Hello everyone, welcome to my first YouTube video. My name's John. As you might see, the name of this video is titled The 4-Year Millionaire Challenge. I have the goal of becoming a millionaire within the next 4 years, and I will outline how I plan on doing that. But before I do that, I'd like to run you through some of the fundamentals that, some things to consider and perhaps live by over the next couple of years, that at least I hope to live by over the next couple of years, and something maybe you might consider implementing in your own life if you have similar aspirations. So let's go ahead and get into the video. There's a very popular term going around, especially amongst younger millennials, known as FIRE. What is FIRE? Financial independence, retire early. And so a lot of younger millennials are finding out, hey, they don't really enjoy working as much as maybe their parents did or their grandparents did, or maybe they'd like to travel a lot more often. Maybe they don't want to be tied down in one place. And so FIRE is often a concept that many people are working towards to try to live life how they would like to live it. And so how do you achieve FIRE? Basically, there's really only one way to obtain financial independence and retire early, and that's basically acquire wealth. How do you acquire wealth? Well, you get a job, either you build up skills and you get better jobs to make more money, or you keep your current job and you spend less to save money. And then once you have the wealth, whether if it's all at once or you add a little bit over time, which is known as dollar cost averaging in traditional investing, you use this wealth to invest in income generating assets. And what are some examples that we can use our wealth? What are some examples of generating assets we can invest our wealth in? Here's a couple of examples. There's high dividend stocks and indexes, there's bonds, there's businesses and bonus points if there's self-managing businesses or the income's as passive as possible. And then there's what I like to call smart investing, which is investing in the stock market. And when I say smart investing, I guess that's people who are more informed, who do a lot more due diligence, and they do a lot more analysis. They do technical analysis, and they try to spot whether it's intraday or intraday or interweek trades that they can make a quick buck on. So let's go over some of these. High dividend stocks or stock indexes. This is a pretty good strategy for, I think, maintaining wealth. But in terms of for the average middle class person, if they're trying to get to an income where they can retire early, especially if they want to do it as quick as possible, I don't really think this is a viable option unless if you are a Nazi about how you spend every dollar. If you're saving 50%, 60% of every dollar you make, this might be, a more viable option. If you make $80,000, for instance, if you can save $40,000 a year for 6 years, and you throw that into, S&P 500 index, and that index earns 10 to 12% every year, yeah, that might be a somewhat viable option for trying to retire early. But for most of us who we have a house, we have a car payment, whether or not we have children or pets, saving 50% of our income is not really a viable option. And so let's take a look at some other, and in terms of wealth maintenance, I would also say, if you put your money in high dividend stocks and stock indexes, the S&P 500 over the long hauls, it is going to perform, 8, 10, 12%. And high dividend stocks, that's kind of a passive income. So there are bonus points there. It is a passive income, and so you just own the stocks and the dividends come every quarter or every year, and so that is passive. But like I said, it's not as aggressive in terms of growth as I would like. What are some other examples of income generating investments? Bonds. Right now, bonds aren't really a good investment. Bonds really haven't been a good investment since we left the gold standard. Back when money was, maturing in value every year, bonds were a better investment. But with inflation, the claim is the Fed tries to keep the rate of money supply increase between 3 to 5% to maintain full employment. At least that's the historical principle we all learned in high school. However, is the Fed inflating even more than that? who knows? And then with COVID, with all the supply side shocks and restrictions, inflation is even higher. So even though bonds is also a relatively passive income generation method, it's probably the poorest performing out of all these options I'm going to lay out. And so I'm just going to kind of drop it at that. Self-managing business. This is an option if you can start and run a successful business, franchises, whether it's a 7-Eleven or a U-Haul or one of those space storage businesses. If you can start a business, you can grow it pretty quickly. And then, but the problem with that is usually it's a lot of headaches. So you make a lot of money, but you're also working a lot to make all of that money. And it comes usually with a lot of headache. And if you have to hire employees, you have employee headaches. And it might take quite a number of years of effort to try and streamline the business to get it to the point where it's self-managing. And so, and especially for those of us who are kind of comfortable in our middle class or lower income jobs living in corporate America, for those of us who have families, children, mortgages, car payments, if we need health insurance, if you start a business, for instance, if you're diabetic, type 1, type 2 diabetic, and you need insulin, starting a business, it's going to probably be really hard for you because automatically you lose your employer's health insurance. So starting a business may not be a viable option for many people, and even if it is, it might take 5, 6, 10 years before it becomes self-managing in that respect. So in terms of, we've kind of eliminated a lot of options, whether, some of these options are not self-managing or as passive as we would like. Other options are not as high return as we would like. So moving on, there's investing in the stock market. And within that, I kind of put, there's day trading, which requires a lot of time, a lot of effort. You got to really know your stuff, do due diligence, read technical charts to make sure investments don't go sideways on you. Most of us living in corporate America, we don't really have that time. So I kind of eliminate that because it's not really passive. There's swing trading, which you can do more. It's more accessible to most people, especially with stocks like that yo-yo up and down, like maybe MVIS or GEOV or some other stocks. You can kind of trade on swings over 2, 3, 4 weeks. But again, I'm not really. I haven't swung trade that much myself, so I don't know the potential there is there. I'm sure there's potential for maybe 20, 30% gains over, 5, 6, 10 weeks, but I guess that's not really something that I'm too into, and I haven't really explored that much. But the last thing I'm going to detail here is something that I am currently exploring, something that I have been doing quite successfully off and on for the past 6 months, doing successfully, and then I'll try and do other stuff like buy and sell calls, buy and sell puts. And when I try to buy and sell options, I don't do too well in those. I usually lose a lot of money. But when I sell exclusively puts, I tend to do a solid, 2% week return, and so I'm kind of sticking to that. And so I also think, selling puts, it has a lot of benefits, right? You get to keep cash in your escrow balance every week. The put expires and you have access to your cash again. So it's almost kind of like a savings account as long as you time the floor right, and you don't get forced to buy too much of the stock of the various investments you invest in. It's almost kind of like having a high yield bank account. And in that respect, you can do more conservative strategies of 0.5% to 1% a week. You can do more aggressive strategies of 2 to 3% a week. And also, it only takes about an hour or two to research over the weekend what kind of stocks you want to sell puts on to get a 1, 2, 3% return on. And in that respect, it's something a lot of professionals can do. They can do it over the weekend. They can set their puts either Sunday night if they have Fidelity or Monday morning if they have Webull or Robinhood. And it's kind of my strategy is I look at stocks I like that I'd like to own in the long term. I see what I think the floor the floor or price support level would be for the next week, and then I tried to sell puts at that level and get a 2% return. Once I sell the puts, I kind of forget them. I might check up on them once or twice a week, but I don't have to pay attention to the investment every day, every minute of every hour of every day to make sure it's not going sideways on me. And so I think this is a strategy, selling puts. It's a lot more accessible to the middle class or lower income person because, you really only need about $2,000 to $3,000 to get started. It doesn't require that much upfront effort. You can do it while you're doing your job. You can set it, you can forget it, and then you can get a consistent 1% to 2% a week. If you get relatively consistent at it, you get good, you research your companies, you do your due diligence. You don't have to read technical charts too much because, if you're just looking at week at a time, you don't have to worry about ups and downs because we're picking the floor. So I think this is a strategy that might be, at least for me, it's probably going to be better to achieve a FIRE strategy, a FIRE position in the next 4 years. And I think, if you look at the power of compounding interest, that it really makes it a viable option for many people who are lower income and middle class. And then let's look at, some form of savings and just compare the different forms of how you can save your money for retirement. So we have bank accounts, 401ks, S&P 500 index, and then my personal strategy of selling puts. And let's look at the projected annual percentage rate of return on some of those strategies of saving your money. If you get a really great bank account, like Smarty Pig by Sally Mae, I just looked this up on Google, you can get a 7% annual rate of return. So if you put $1,000 in there, you're going to get $70 in return over a year. If you put your money in a 401k, you can probably get 5 to 8% depending on, the investment plan, the manager of that plan. Once again, I found this on Google. I think once you've established wealth, this is not to say that you shouldn't invest in your 401k, especially if you get an employer match. Employers often match 50 or 25% for every dollar, up to 5% or something like that. So you should definitely, up to the employer match at the very least, contribute money because you get an instant 50% return on your money. But that being said, I'm a little hesitant to put more money above the employer match just because you don't really control what investments it's in. You can't pull the money out, so it'll go up and down with the stock market. And if you retire early before the age of 65, you can't really touch that money without huge taxes and penalties. Now, this kind of brings us to an S&P 500 index. I think S&P 500 indexes are really good for the person who's already established their wealth, and they just kind of want to maintain it to beat inflation of 3 to 5% every year. In that respect, an S&P 500 index is really good for upper middle class and rich people who've already retired or whatnot because they can just keep the money in there. It'll grow over time. They can maybe sell calls in the index out of the money calls and make maybe another 12% a year on the calls. And so I think an S&P 500 index, once you've established your wealth position, is really good. Hey guys, as you watch this video, you're going to hear me say throughout the video quite a bit, as long as you get 0.5% of return a week, you're going to double your money. I misspoke. So as you can see on the screen, I had a calculation error. I should have deducted the original 100% out of the ending balance. And so what I thought was 130% return was actually a 30% return. What I thought was 192% turn was actually a 92% turn, and so on and so forth. So I'm going to say throughout this video quite a bit that as long as you get 0.5% of return, you're going to double your money. I misspoke. If you get 0.5% of return every week, you're going to increase your money by 30%. You're going to get a 30% return. If you get a 1.5% return every week, you're going to almost double your money. You're going to go from $1,000 to $1,900. So as you watch the video, have that caveat in mind that I misspoke with this with this narrative in this one respect. And please try not to judge me too hard on that. And thank you, and I hope you enjoy the video. Now that being said, I'm moving on to my put strategy, was I like to sell, especially on higher beta stocks that I think have good long-term run value, such as Microvision or a number of other stocks we'll go over. I think selling puts is a great strategy for building your wealth, and almost as the same time kind of using it as a somewhat higher risk savings account. And because, like I said, if you maintained as just selling weekly puts, as long as you time the floor right, you always have access to that money within 1 week, and then you can wire it out of your escrow account to your bank account within a week after that. So as long as you time the floor right, the longest it takes to have access to that money is 2 weeks. If you have an emergency expense, you can go ahead and run it on your credit card and repay it out of the money from your brokerage account. And so in that respect, it's selling puts in a brokerage account is almost kind of like having a bank account. If you put money there and you're conservative with your puts, like if you do a 0.5 to 1% put on the right companies outside of a black swan event like 9/11 or COVID, more 99 times out of 100 you probably won't get called on those puts, and so you'll just be earning 0.5% or 1% a week on those puts. And like I said, you do it once, you set it on Sunday, you set it and forget it, and then it's, if I have to work 1 hour a day every Sunday to make 60% a year return on my money, I'll happily do that rather than just getting 10% on a S&P 500 index, at least up to the point where I build my wealth, right? And so the put strategy I'm laying out here, if you get 0.5% return every week, that's a weekly compounding annual rate of 130%. If you get 1 to 1.5% return a week, that's an annual compounding rate to 192%. So you basically double your money. If you get 2 to 2.5% a week, that you're tripling your money. And if you get over 3% a week, I find probably 3% is a little hard. That's where you're starting to be a lot more risky. You have a lot more chance of getting called on your puts. I think the sweet spot where you do a little bit of work is probably 1.5 to 2.5%, with 2% being like your golden. And so, but yeah, if you're good at this and you're able to get 3 to 3.5% without ever getting called on your puts, you're 5xing your money every year. Now, of course, this doesn't take into account taxes because I just did a simple calculation just for presentation purposes. So if you figure you make quarterly payments, probably all of these rate of returns are going to be about a third less, including taxes. So the 0.5% is going to be like 90% return. The 1 to 1.5% is probably going to be like 140% return. The 2 to 2.5% is probably going to be like 240% return, and so on. But you get the idea. Selling puts can be a high return thing every week. Your investment's only tied up with 1 week at a time. So you, at any given time, like I said, as long as you time the strategy, you time the floor right, you have access to your money in 2 weeks. So in this respect, out of all of these investments, the put strategy kind of wins out in terms of rate of return over the year. And then let's keep going. What are some pros? Bank account, you have quick access to the money. It's low maintenance. You don't have to do anything. For the 401k, it's tax preferred. So, and also I forgot to put here, but also matching employer contributions. So with the matching employer contributions, you get instant 50% return, and then you can get a tax deduction for contributing to your 401k. And once again, it's low maintenance because you're having a manager manage it. The S&P 500 index, same. Similar to a bank account, you're going to have quick access to your money. You can liquidate it. It's also low maintenance. You just put money in there. Maybe you sell calls for an extra 5 to 10% a year. But I guess there's a caveat to the quick access to your money. I would say 99 times out of 100, there's quick access to your money. That being said, let's say you have a down day in the market or you have a down cycle in the market 3 or 4 months at a time. You may be taking a hit when you take your money out. Now, if you've had an S&P index for 10 years and you have an ultra low basis, that's not particularly, it doesn't really hurt you that well. But when you're first starting out in the S&P 500 index, because you haven't had the time to dollar cost average over 10 years, there might be times where you're below basis a little bit if you started investing at a higher point in the S&P 500. And so, if you 6 months later after you start investing in the S&P and you have to pull money out, you might take a loss doing it. But I think, once again, for a person who's established their wealth, over time an S&P 500 index is probably pretty good for them. Now let's go on to the put-sell strategy. It's the put-sell strategy is going to be a lot more maintenance than any of the other things. Like I said, you're probably going to spend 1 to 2 hours a weekend researching things, and then you're going to, every week, 52 times a year, 52 hours a year, you're going to, every Sunday or Monday, you're going to engage in those cash-covered puts, and then, so it's going to be a lot more maintenance than the other accounts, but at the same time, even if you're ultra conservative with a 0.5% weekly return, you're doubling your money every year. I'd rather spend 52 hours a week and double my money every year than not spend 52 hours a week and not double my money every year. So for instance, if I start with just $10,000 and, if I double my money every year, now it becomes $20,000. That increase of $10,000, that's $10,000 you made for 52 hours worth of work. So that's what? That's making $20 an hour or something. Let's do some math here real quick. So we have $10,000, 52 hours. I think it's $20. No, it's $200 an hour. I was off by a rounding error. So yeah, if you spend an hour every weekend doing this and you double 10,000 into 20,000, you're getting paid $200 an hour for that maintenance. So I much rather prefer, at least, I'm still learning the stock market, but I've found that this strategy works best for me. It's without being a day trader, without all the heartburn and the anxiety of watching the stock go yo-yo up and down. This is the best strategy I've come up with to try and build wealth quickly. And so, but going on with the presentation. Cons. The bank account, even though it has quick access, low maintenance, it has a low ROI. The 401k, you have delayed access to the money. It has a moderate ROI. I'd say the delayed access or expensive access, for a FIRE strategy, if you're trying to retire before under the age of 40, you're going to take huge taxes and penalties to be able to access any of that money. And those taxes and penalties are probably going to wipe out a lot of the gains you've had. So, like I said, make contributions to your 401k up to your employer match, and, even with this put-sell strategy, I think you should also, at the same time, make your 401k or Roth IRA contributions. But I would say if you want to retire early, you should be more concerned about building investments outside of your 401k or your IRA, because in the end, you're not going to be able to touch your 401k or IRA until you're like 65 or some other such nonsense. The S&P 500 index, same, and has a moderate rate of return, and you can boost that return up by selling out-of-the-money calls. If you can get 0.25% to 0.5% every week selling calls, you can probably goose up your return to, 20, 30, 40, 50% every year. But at the same time, you probably also don't want to sell your calls too close to the money, because if the calls get acted on and you have to sell all of the S&P 500 index, you're going to especially if you're more established later on in your life, you're going to have a lower basis and a lot of gains built into that S&P 500 index. So you might end up having to pay a lot of taxes. So definitely when it comes to selling calls to goose up return, you want to be careful that as you get more established and you have a lot more gains built into your position, that you don't sell too close and get the calls activated, because then you might end up with a huge tax bill at the end of the year. Moving on to the put strategy, even the ultra-conservative method of 0.5% a week, it's doubling your money, so everything is high return. And then when you're able to get to the 2 to 2.5% return compared to the others, it's an ultra-high rate of return. So that's why I'm leaning towards the put-sell strategy. Last but not least, are things FIRE suitable? No, for the bank account, it's the rate of return is just way too low in order for it to help you retire under the age of 40, unless if you've been saving since you were 14 working at Target or something. The 401k also, again, even though it has an okay rate of return, it's not high enough for middle class or poor people to build wealth into a position that's over the long life after they retire to help them live. And then on top of that, delayed access, expensive to remove your money, sometimes to the point of wiping out your gains. And in that aspect, 401ks and IRAs, they're good for when you've retired at the legal age to retire, but before then, it's kind of a crapshoot using them as a retirement. S&P 500 index, it has a moderate ROI, which is good, but once again, it's not really a position that allows you to helps you to build wealth. It only helps you to conserve wealth that you've already saved, and in that respect, once again, I think S&P 500 index is really good for people who have already built out their positions in life and then just want to maybe live on 10% annual return every year, or on top of the 10%, maybe they sell calls and make another 5 to 10% or 20% on that. So in that respect, once again, the S&P 500 index is really only for people who've already made it, so to speak. For the put strategy, I think this is, if you want a low effort, high return way of trying to build out wealth quickly enough to retire, and I think you can do that in 3 to 5 years, depending on how much money you put into it. But, with a little bit of work, with a little bit of learning, I think that this ticks all the boxes. It's extremely high rate of return. If you time the flow right, you have access to your money every week, and it only takes about 2 weeks to actually get your money out of the brokerage account. 1 week, let's say if you start on a Monday and you say you need the money, it takes 1 week for your positions to expire and you get the premium free and clear. Then it takes another week, 5 days theoretically, for the funds to clear from the brokerage account to your savings account. Everyone has access to knows 0% interest for a month credit cards. So literally, anyone can do this strategy if they have, a short-term emergency expense. They can just, if they need to, use their credit card and then pay it down once that week's investment has cleared, the premiums in their pocket, and then they can just wire the money out of their account. And this is also to go back to say, if the stocks are going up, the liability position you're in when you sell the puts is devalued. So as long as stocks are going up, you can buy yourself out of your put position for pennies on the dollar. Just a week or so ago, I bought myself out of an ASO put for 13 cents on the dollar because ASO was climbing so high. So there are some instances where you might be lucky enough that you've sold a put, then the value of the stock has gone up, the value of the put has gone down. You can buy yourself out of the put for pennies on the dollar and still have all of your original principal, some of your 1 or 2% gains, and then you can wire the money out of your account for that emergency. So there's even instances where you don't even have to wait 2 weeks. You might only have to wait 1 week, which is the money to clear from your brokerage account to your personal account, if the stock goes up. If it doesn't go up, if it goes down, as long as you time the floor right, the options expire, the premium goes in your pocket, and then in that case, worst case scenario, the conservative case scenario is it takes 2 weeks to get your money. I think this is the end of this slide. Okay, now I want to show you the power of compounding weekly interest. As I was saying over here, you can see I was saying, if you get 0.5% of return every week, that you double your money, you get 100% rate of return on your money. That might seem crazy, but let's look at the math right now. So let's see if we have $1,000 that we put into account, right? And we put $1,000 into the account. As you can see, 5% rate of return per week, we have $50. And you can see I'm doing simple math here. I'm just, the next number below, I'm multiplying the next number below is the product, the bot of the number above, multiplied by 1 plus 0.5%. So you can see we got 0.5% difference from here. The first week you had $1,000, now you have $1,005. The next week, you had $1,005. Now you have $1,010.03. Next week, you had $1,010. Now you have $1,015.08, and so on and so forth. And you can see that after 52 weeks, we have is that right? Oh, I'm sorry. It's not. You're not doubling your money. You're getting 30% on your money. I misspoke when I said before that you were getting double your money. That what I should have said was you're getting 30% on your money, because as you can see here, we went from $1,000 to $1,300. But again, 30% is still better than 30% is still better than. So if I originally had that $10,000, we would have $13,000. So $3,000 divided by 52 hours is still $58 a week you're making in this example back here. So I did misspeak, but even though I misspoke, the rate of return is still great for 0.5%, because you're getting 30% return on your money. And so going back here, when you have half a rate of return a week, you're getting 30% on your money. You started with 1,000, you get 1,300. And as we know, there's 52 weeks in a year. So if you have 1% rate of return every week, that's fairly easy to do. Even low beta stocks like Viacom, you can easily get 1% rate of return a week. And Viacom right now, they're at a historic low because of the Archegos incident. So you can find 1% rate of return puts left and right in the market. And when you do 1%, you're going to turn over a year, you're going to turn your $1,000 into almost $1,700. If you do 1.5%, that's where you double your money. Once again, you can find 1.5% fairly commonly. When you do 1.5% rate of return a week, it's equivalent to doubling your money every year. You turn your $1,000 into $2,100. Once again, this is not including taxes. Taxes becomes a lot more complicated to map out, and then it gets even more difficult. Are you making weekly or monthly or quarterly contributions, and then are you paying the taxes quarterly? Are you paying the taxes? Are you paying more through your current job to pay the taxes? Or are you just making the quarterly contributions? That gets a lot more difficult to map out, so I've taken out taxes to simplify it. But more or less, you can see that it's a high rate of return. If you do 2% a week rate of return, you're almost tripling your money. You start with 1,000, you get 2,800. You can do 2% rate of return a week. It's not as easy as 1.5. I think it requires a little bit of higher beta, newer companies, but I think it's also still somewhat easy to get 2% a week. It's going to involve a little bit more risk because, as I say, it's going to involve higher beta, newer companies. But as you know, we're only selling weekly positions, so even though I like MVIS, it hasn't been profitable because it's a new company. It might take a couple of years to be profitable. You still have, because you're only in the position a week at a time, as long as you're paying attention to the companies and the news about the companies, you can kind of get a sense long before a company's in trouble of whether or not you should be exposed to the company at all. For instance, Barnes & Noble. Barnes & Noble has been that's a high beta company, but I would never sell puts on it because if you look at their business model, you can just see that they've never had a positive net income in almost a decade. And then on top of that, who reads books anymore? And if they do, who goes to Barnes & Noble to buy books anymore? No one. Everyone buys their books from Amazon or eBay or wherever. No one goes to Barnes & Noble anymore. At best, there might be the occasional boomer who might go to Barnes & Noble with their husband or wife to buy some coffee, to hang out at the mall. But that's why, I would never sell puts on Barnes & Noble because, honestly, I would never invest in that company in the long run. So I wouldn't sell puts on them because I don't want to be exposed to a company I wouldn't invest in the long run. But that being said, you're only selling puts a week at a time, so you can play the risk card a little bit tighter, especially if you diversify all your puts across a number of companies. So, saying long-winded way of saying, it's easy to get 2% return a week. You're just going to be exposed to higher beta companies. And in my personal opinion, if you are going to expose yourself to higher beta companies, you should expose yourself to those companies that you want to be invested in the long term, so that if you do get stuck with their stock, at least you think it's going to grow in the long term. 2.5%, this is where you're over tripling your money every year. 3%, you're over 4xing it. 3.5%, you're almost 6xing it. And 4%, you're almost 8xing it. And so, as you can see, this put sell strategy, especially when you target a 1 to 2% rate of return every week, the pennies start to add up real quickly. You're not going to be rich overnight. I like to say it's not get rich quick, it's get rich quick enough. And so for those of us who, might have grandiose ideas of retiring in 3 or 4 years, this might be a viable strategy you want to maybe practice with $2,000 or $3,000 for a year. And then if you can get a solid 2% rate of return on your money, and you turn that $2,000 into $6,000, well, then you might want to consider moving the money in your bank account, or most of it. Maybe you keep 3 or 4 months worth of expenses in your bank account and move all the rest of it to this. But it's just something to consider. If you want to explore the idea of retiring early, 401k is not going to do it. Cash savings account isn't going to do it. Investing in bonds isn't going to do it. Day trading might do it if you're really good at it, and then it'll take a lot of time and you'll have a lot of energy and effort put into it. For me, I find that this is probably the highest rate of return per level of input effort that I can come up with. And let's look at the year-over-year returns. And as you can see, if you're getting a 0.5% rate of return every year, and you just, with $1,000, 1 year you'll have $1,300. In 10 years, you'll have $13,000. If you're getting a 1% return every week, in year 1, your returns are going to be $1,700. In year 10, you're going to have $176,000. So imagine you're 18, right? You're 18, you start working at Publix, you put $1,000 into your brokerage account. By the time you go through college, you don't touch that money, you just sell puts every week. By the time you go through college, you get a job, you find a wife, and you say, hey, I want to buy a house. Money you put away 10 years ago is now enough to put a down payment on a really nice house, or buy an older, still somewhat nice, but older, smaller house, free and clear. How awesome would that be? And that's just 1% rate of return every week. If we're looking at 1.5%, this is where in 10 years you become a millionaire. If we're looking at 2% rate of return, this is where in 10 years you have a lot of money, $30 million, and so on and so forth. And I think the math here that really, really starts to pan out is if you are getting these consistent 1 to 2% rate of returns every week, and then if you contribute just something like $250, like $50 every week or $100 every week, that's where in 5 years you can get to millionaire status. 4 years, 5 years. And so let's just do some math right now. I'm going to go back here, and let's say I'm just going to edit this formula at 2%. So this is our original principal times the 2% return. And then I'm going to add $50 every week into my investment. I'm going to add $50 every week to my investment. I'm going to go ahead and drag this formula down. Oh, that's only 52 weeks. Okay. So what we're going to do here real quick, if we have I'm sorry guys, I should have had this prepared. Let's go out to here. and at the 2% rate of return, so here you'll see if you sell puts and you get about 2% return a week, sometimes you might get 1.5, other times you might get 3.5. If you're really good, sometimes you might get 3, but if we can average 2% premium every week, that, we try to time it so that we don't ever hit the floor. And in times when the stock market's going down, maybe we have a higher spread and we only get 1.5 or 1% rate of return. And maybe when the times our stock market's going up, that's where we ride the floor closer, and maybe we get 2.5, 3% return, and it kind of averages out to 2%. And like I said, when the stocks are going up, you can often buy yourself out of these stocks for pennies. Buy yourself out of your positions for pennies on the dollar, and then you might consider maybe selling new puts to get even more premium. But that's something we can discuss at a later time. But I say all that to say I think you can average 2% rate of return pretty easily if you maybe do 6 months of looking at stocks, looking at options, and just looking at how you can practice on one stock, maybe pick Microvision or Fubo or ASO, it doesn't matter. Pick one stock and just try to read the stock and see if you can pick where the levels of support are, the levels of resistance are, and it should be fairly easy, really quick to pick up on a 2% rate of return. But as you can see, if we can average 2% rate of return, and then every week we add $50 on top of that, we are going to be at $1 million in week. Let's see. Once again, this is not including taxes because that just gets to be a little more difficult. So in week 286, we're at $1 million, where every week we just added our 2% week of return, and then we added $50 out of our own pocket. The point is, selling puts, you can make quite a bit of money. And so my strategy to become a 4-year millionaire is I'm going to try to sell puts getting between 2 to 2.5% a week. And I'm going to be trying, once I pay off my truck, I'm going to be contributing $1,000 every month into it. And so inside of 5 years, I'm hoping to have inside of 4 years, I'm hoping to have over $1 million. And then from there, if I can get even just 1% a week on the $1 million in my investment account, I'm going to be getting $10,000 a week. And then at that point, it's just, I'm going to then begin to diversify my portfolio out of just cash covered puts into the S&P 500 index, into stocks, into crypto and whatnot. And so, but I want to try to build up my wealth as soon as possible to try and have a basis where I can almost make passive income by selling puts once a week, doing the homework on Sunday, and then putting it in on Monday, and doing nothing the rest of the week. And so that's going to be my strategy. Thank you for coming on this journey with me, and you can see what I do. If you have any suggestions on better stocks to play, or if there's some stocks you think I should look at, feel free to let me know in the comments below. Feel free to hit that like button and subscribe to see how I do over the next 4 years. And I'm going to have coming videos in the future talking about, what plays I'm doing, and then stuff we can learn about in order to learn about the stock market, whether it's about options or about financial lingo such as due diligence or 10Ks and 10Qs and stuff like that, compounding versus non-compounding interest. And so feel free to subscribe to see how my journey goes, and hopefully in 4 years I might be considering quitting my day job. But until then, I'll see you later, guys, and thank you for your time.